We'll finish up with the outlook on Europe from our colleague from Paris, Julien Marcilly. He's the chief economist of Coface. He came here from Paris. He was yesterday with us in Chicago on the Country Risk Conference, and today here in New York. Thanks. And we'll finish up with the topic Europe, safe inside, unsafe outside. Let's go.
Hi, good afternoon, everybody. Thanks a lot, Stuart. Good presentation, as always. Just before the conference started, we met with other speakers, and we drew the straw just to split the world and to see who is going to cover the US. And I got Europe. So usually when you get Europe, you're quite unhappy because it means you're going to have to tell a lot of bad news. But to tell you the truth, this time is a little bit different. So I'm quite happy. Not as happy as one following Real Madrid's win, but I'm quite happy. I'm quite happy because that's the key message of my presentation. The outlook on Europe is definitely improving, at least from a macroeconomic standpoint. And it's definitely much better compared to what's going on in the rest of the world. I will be fast on this because all of the speakers have already talked about that. But it's just to stay with a gloomy tone a little bit. At the global level at the moment, we're stuck in an environment of low growth and low inflation. So in other words, it means that more and more countries look like Japan. For businesses, it's not really good news. It means that, of course, you have to face with lower demand. You have lower pricing power. But the only one good news coming from this new normal, I would say, is that at least companies can survive because of very cheap credit condition. The problem is, Stuart has already talked a lot about this. The problem is that another consequence coming from very loose monetary policies is related to financial market volatility. So we have to be used to see large ups and downs on financial markets. And for businesses, it's not really a good news as well because it means that they have to face with a lot of uncertainty and they don't necessarily decide to invest in this kind of environment. So the year didn't start very well with markets going down thanks to what's going on in China and in the commodity market. Now it looks better. Once again, thanks to China. Just in a few words, it's true that when you look at official data, cyclical indicators coming from China since the starting of the year, it looks like the situation is stabilizing. Just in a few words, we don't believe in it. We don't think the situation is improving or even is stabilizing in China, just because if you look at it from the corporate side, we still see that the situation is deteriorating. And just to give you some fresh figures, at Coface, we provide on a yearly basis a survey where we ask about 1,000 corporates based in China, a very large number of questions related to their payment behavior. And the last one is very interesting because more and more companies are saying they are facing problems related to growing overdues. And this is what you can see here on this chart. Specifically on the one which is on the left, you see that more and more companies are saying that the average overdue they're suffering from is a very long one. 10% say they have to face with very long overdue payments on average. It's much higher than it used to be the years before. And the result of that is, you see it on the right part of the slide, is that this very long overdue now account for a larger part of their turnover. And we know that around 80% of this very long overdue won't be repaid back at all on average. So it means that even though cyclical indicators show some sign of improvement since the starting of the year, on the ground, on the corporate side, we don't see any sign of improvement at all. So now the next question is, what's the impact of this China slowdown on the rest of the world? I won't focus on emerging markets, which by definition are the most impacted by what's going on in China, but I will focus more on advanced economies and more specifically on Europe. So to do so, to reply to this question, to answer this question, we have tried to measure what's the impact of a 1% decrease in industrial production in China on large advanced economies. You see 7 advanced economies here on this table. Why focusing on industrial production? For a very basic reason. It's because most of the problem in China come from the industry side, not from the services side. So here is the statistical results. So what do statistics tell us about this? First of all, for countries that are in the bottom, basically Italy, France, and Spain, nothing. But to some extent, this is not really surprising. This is a confirmation that those countries are not really exposed to what's going on in China. They don't export much to China, so it's not really a surprise. So then the next question is, what's the consequence for other countries? And the best way to look at it is perhaps to look at a specific figure. Look, for example, at the third column for Germany, 0.48. What does that mean exactly? It means that according to this statistical model, a 1% decrease in industrial production in China implies about a 0.5 decrease in industrial production in Germany 3 months later. And when you take into account the share of industry in the GDP, you got the last column, and it makes you possible to classify countries according to their exposure to China. And so the picture is quite crystal clear. You see it. I mean, 2 countries look much more exposed than other ones related to what's going on in China. It's Japan and Germany. And it's not, once again, it's not really surprising. And Germany has already started to feel the pain. When you look at export figures over the past years, I mean, export growth has weakened quite significantly, mostly because of what's going on in emerging markets. So it doesn't mean we are very pessimistic on Germany, not at all, but it means that we have to be cautious and we have to look at the situation on a sector-by-sector basis. And this is what you can see on the right part of the slide. Some sectors, you see on the right part of the slide, on a sector-by-sector basis, the share of exports going to emerging markets as a whole and going to China. And you see that some sectors seem to be really exposed to what's going on in China, especially the ones which are on the top of the chart. So sectors like mechanical engineering or electrical equipment. In the bottom, on the opposite side, you see that some of the ones, like the pharmaceutical sector, looks like much more immune from what's going on in China. So risks, that's the first point. Risk in Europe at this stage mainly comes from the external side, from what's going on in the emerging markets and from what's going on more specifically in China. Because the good news is, and this is the key point of my presentation, on the domestic side, the situation is really improving. Consumption is really growing quite fast over the past quarters for a very basic reason. Okay, the key one is low inflation. Low inflation means that wages adjusted from inflation are growing, and so the purchasing power of households is growing quite steadily. You see it here on the left part. The second reason is even more basic. Unemployment has started to decline in almost all countries in Europe now. My home country being an exception, unfortunately, but in all other countries, unemployment has started to decline. And the last one, we don't focus much on this, is that fiscal austerity is coming to an end in Europe. So all of this means better prospects in terms of private consumption. And the outcome is that a larger part of GDP growth is now driven by private consumption. You see it on the right part of the slide. So you're going to tell me, okay, but it has always been the same. That's true. But let's say it's even more true now. Look at the contribution of private consumption on GDP growth on the right part of the slide. It's growing in all countries in Europe, even in US and in the UK. But for the Eurozone as a whole, it's now 2/3 of GDP growth, which is driven by private consumption. And it's higher than it used to be over the past couple of years. So what's the consequence? One basic consequence is that all sectors which are relying on private consumption are doing well. You see on these slides retail sales which are trending up, and it's an opposite trend as in some other countries like the US, like Brazil for sure, and even China. And in sectors like the automotive one, we also see that the catching up process is ongoing. And here you have to keep in mind that there are still plenty of space to grow quite steadily in the years to come, because the recovery process in Europe is at an earlier stage than it is in the US. So, for example, in the US, we start to see car sales to slow a little bit. And it's normal, because car sales have recovered their pre-crisis level. So you can't expect car sales to grow by 5 or 6% a year in the 5 coming years in the US. Now it's going to slow, but we are not at the same stage in Europe. The recovery has just started, so we can be optimistic for the years to come in all sectors related to private consumption. And of course, when you are in an environment of lower unemployment, higher consumer confidence, and low interest rates, the construction sector is doing quite well as well. So Stuart has already talked extensively about it related to the US, but in Europe, one of the roots of the recent crisis is the same. It was related to an excess in household debt in some countries like Spain, like the UK, and so on. And now we see the opposite trend. The trend is really up in all countries. You see it in both charts. And even in Spain, which was really impacted by what went on the construction sector, you see that the worst is definitely behind us, even on the construction sector. So what does that mean for businesses? It means that for sure they are now in a better shape. Here you see business insolvencies. They are declining in all countries in Europe. So to tell you the truth, it's true that in some countries, business insolvencies are still much higher than they used to be before the crisis, for example, in Italy and in France. But nonetheless, they have started to decline. And another good sign is, you see it on the right, that's France example, but business creations are climbing quite strongly. So all of this means that we see positive effects on the corporate side coming from what's going on the consumption side. And this is true for almost all sectors. Here you see the breakdown of insolvencies in France on a sector-by-sector basis. And you see the evolution between 2012 and today. So over the past years, you see that insolvencies have declined in almost all sectors, especially the ones related to private consumption. So this is not a surprise. The only one exceptions are sectors related to commodities, so the metal sectors, the agro-food sectors. And once again, this is mostly due to global factors, of course. So all in all, corporates are in a better shape, for sure. Corporate margins have started to bounce back because of what's going on the demand side, because of low oil prices, which is helping as well. And we think this is going to continue. You see our forecast for France on the right part of the slide. The only one problem is that, okay, consumption is doing good. Corporates seem to be in a better shape. Their margins is increasing, but to some extent it's quite puzzling. But despite all of this, we don't see so far any sign of strong pickup in private investment. Usually in normal times, in normal recovery times, investment should grow much faster than GDP. And this is not what we see here in Europe, Spain being an exception. You see it on the left part of the chart. So the result is that there is a lack of investment in all countries in Europe. The investment to GDP ratio has declined and has not recovered at all is pre-crisis levels. How do we explain this? How do we explain this puzzle between, on the one side, the cyclical situation, which is definitely much better, but on the other side, investment which is not picking up? First of all, by overcapacities. In a lot of European countries, we still see a lot of overcapacities. In other words, it means that corporates can produce more without investing. And that's the reason why we still don't see any sign of strong pickup in investment. And I would say the second reason why that's the second key risk to monitor at this moment in Europe. The second reason why we don't see any strong sign of pickup in investment at this stage is of course because of political uncertainties. And that's the key point I wanted to highlight here. So Of course, when we talk at this moment about political uncertainties in Europe, everybody think about what's going on in the United Kingdom. So the referendum about the Brexit will take place on June 23. It's very difficult to know what's going to be the outcome of this referendum. When you look at the poll, it's a little bit useless because the margin is really narrow. It seems that the population is really divided. I mean, when you look at the polls, 1/3 stand for the Brexit, 1/3 stand against the Brexit, and 1/3 doesn't know yet. So my feeling is, when you look at the news in the UK, when you look at the newspapers and so on, the debate, unfortunately, is more and more on migration and less on the European Union. And from my experience in France, when there is a referendum with more and more debates on migration, it doesn't smell very good. But on the other side, when I talk to persons who are based in the UK, most of them tell me the same. They tell me that, don't worry, in the end, even people who don't like the European Union, they won't vote in favor of the Brexit because they will be afraid of what could go on if the UK leaves the European Union. So I don't know what's going to happen, but let's imagine the worst case scenario, and let's imagine that the Brexit win. In this case, you have to keep in mind that there's going to be a 2-year transition period before the UK leaves effectively the European Union. So 2 years, it's a lot of time. And it's more than enough for the United Kingdom to negotiate a free trade agreement with the European Union. And in the end, being inside the European Union but outside the Eurozone, such as the UK at the moment, or being outside the European Union but benefiting from a free trade agreement with the European Union, is not so different. The key risk is more in the short term. What's going to happen on financial market? And we go back to what Stuart said. We don't know. That's the key risk. But the key risk is not really for the real economy in the medium term for the UK economy. So I was talking about rising political risks and risks related to the migration debate at the moment. It's not only an issue for the UK. I'm sure you have heard about it in the news. The migration crisis in the Eurozone, in Europe, is having more and more dramatic political consequences in Europe. So the paradox is, in Europe, we need more migration. I mean, our economies need to avoid a Japan-style stagnation because of population aging. But the problem is, in the short term, it's true that social concerns of a growing part of populations in most European countries prevail. So first of all, the concerns related to migration were financial ones. More and more people were wondering what's going to be the cost of these additional migrants for our economy. Now the problem is, I mean, these concerns are more and more numerous. I mean, they're related to borders, they're related to sovereignty, they're related to culture, to security. So it's having dramatic political consequences on our countries. The recent deal which has been signed between the European Union and Turkey seemed to help a little bit. You see the flow of migrants to Greece and Italy that has been cut quite drastically over the past months. But having said this, it's not because the flow of migrants has been cut that the support for far-right parties in Europe is diminishing. And that's even the opposite. I mean, you have seen perhaps the election in Austria, you have seen the recent election in Germany, and next year we will have a heavy political agenda in France and Germany. And it's true that that's a key risk at the moment. And that's one of the reasons why we have also to remain cautious on the economic side. Beyond this migration crisis, what we have seen in Europe over the past couple of years is a fragmentation of political stages. A good way to illustrate it is to look at the left chart here. You see the number of political parties that are represented in national parliament. And you see the situation before 2010 and after 2010. Before 2010, we have split Europe between Eastern Europe, Northern Europe, and Southern Europe. And before 2010, the situation is pretty much the same in all sub-regions. But the key change is since then we have seen that there is a rising number of political parties that are represented in parliament, especially in Southern Europe. So when political stages are more and more fragmented, it means that it's more and more difficult to get a majority, it's more and more difficult to govern, it's more and more difficult to take structural measures, and in the end, it doesn't help. The only one good news related to this trickier political situation is on the fiscal side. Most of these, non-traditional parties are in favor of more fiscal spending. And so it's helping an ongoing trend, which I've already mentioned earlier, is that fiscal austerity is coming to an end in Europe. And you can see it on the right part of the chart where I've put the annual variation of the structural primary budget balance. It's a very complicated name to say something very simple. It's a good proxy for fiscal austerity. So when you see the indicator is positive, it means that government decides more fiscal austerity. When it's negative, that's the opposite. So let's look only at the blue bar, which is the Eurozone as a whole. And you see the situation in 2011, 12, and 13. You see the score is very positive. It's a confirmation that there were a lot of fiscal austerity dragging on growth during this region. In 2014 and 15, you don't see anything. It's not a mistake. It's just that the score is at 0, meaning that, in other words, you can say the fiscal policy is neutral. And for the first time with this year, we expect it to be negative. In other words, it means that the fiscal policy will help for the first time. So that's the key ideas to have in mind related to Europe. From a macroeconomic standpoint, the situation is definitely improving, but we have to keep in mind two key risks. The first one is what's going on in emerging markets, and more specifically in China. And the second one is what's going on the political side. So we try to take all of this into account to provide country risk assessments. So the goal is to measure the average corporate credit risk in a given country. So we look at our payment experience at Coface, a very large number of financial and macroeconomic indicators, and our own assessment of the business environment. And here you get the situation for key advanced economies, and in particular European ones. And the outlook, just look at the last column, the one which is in gray, named March 2016, because we update them on a quarterly basis. When you see red, of course, it means there have been a downgrade, and when you see some blue, it means that there have been an upgrade. And it's just a confirmation of what I've said. The situation, we have upgraded a number of Eurozone countries over the past quarters and couple of years, meaning that the situation is improving. And I will be very fast on this, but the situation is pretty much different in the rest of the world. That's exactly the same as the previous table. So you see a lot of red, meaning that the risk is elevated. And just to give you an example, to show you how we are cautious on emerging markets at this stage, since the starting of the year, this is the first time since 2009 we have downgraded so many countries in the world, and most of them come from emerging markets. So in other words, and this will be my final one, the world at the moment is very divided between, on the one side, what's going on emerging markets, and on the other side, what's going on, I would say, advanced economies, and more specifically on Europe. And another way to look at it is to focus on not on a country-by-country analysis, but on a sector-by-sector analysis. And this is what you see here. We look at our payments experience at Coface and financial data from listed companies all around the world, and we get this 4-grade sector assessment, and the picture is quite crystal clear. All sectors related to commodities are doing pretty bad, of course. On the other side of the scale, you see that all sectors related to private consumption are doing much better. And if you look at it on a region-by-region basis, of course, emerging market regions, and more specifically Latin America and more also Asia, are doing quite bad. But on the other side, the only two upgrades we have decided recently are for Europe, and the situation in Central and Eastern Europe is also quite good. So that's a pretty good summary of my presentation. Thank you very much.